Hi and welcome to lesson 10 in Finance for Business Studies. In the last lesson we looked at liquidity ratios, that was the current ratio, and today we're going to look at some profitability ratios. So again, to recap, financial ratios communicate the financial health of the business. They give us a snapshot of information of how the business is performing. Usually they're used on reports, they're used to plan ahead, to strategically look at how the finance is being used, and also sometimes for shareholders to look at whether the business is a good investment. One of the great ways to know if a business is a good investment is to know the profitability of the business, and we can do that by using profitability ratios. The first profitability ratio that we're going to look at is the gross profit. Then we're going to look at the net profit ratio, and then we're going to look at the return on equity. So what is the return on the investments in the business? They're the three profitability ratios. To look at the profitability ratios, you need to use two different statements: the income or revenue or profit or loss statement and the balance sheet. And I'll show you which components you need to look at now to calculate those ratios. So first of all, the gross profit ratio. The gross profit ratio equals sales revenue minus cost of sales. That's how we calculate gross profit. So we take the revenue of sales and we minus the cost of sales. It will indicate what percentage of each sales dollar equals gross profit. Do we think that the sale price that we're using to sell the goods at is a good and adequate one? The information we get is from the income statement. Now you also know that as the revenue statement or profit and loss statement. The ratio is gross profit ratio equals gross profit divided by sales times 100. So we're looking at the percentage. You need to write this one down and you need to practice calculating the gross profit ratio. Let's have a look where we get the information from. So the information comes from the income statement, and you can see here we're looking for the sales revenue, not the cost of sales. We're looking for the sales revenue. So the sales revenue and the gross profit are shown on here. Remember the calculation. If we go back one screen, we needed to know the gross profit divided by sales. So let's find the gross profit. Gross profit is here, shown on the statement, 1742.1. The sales, 9849.5. Times 100 will give us 17.7%. Before we do that, it gives us 0.177. If you do that calculation, you'll get this result. That means for every $1 of sales, Amcor generates 18 cents in gross profit, 0.17. So 17.7% of all their sales is generated in profit. If we're comparing across years, comparable across years, and we look at the gross profit ratio from the previous year at 15.6%, this suggests that they are generating slightly more sales. It suggests that their sales are a little bit more adequate and the price they're setting on their goods is more adequate. They're generating more gross profit on that sales. It may also mean that their cost of goods have fallen, so they're selling more and making more money. Next profitability ratio that we're going to look at is the net profit ratio. To calculate net profit, we need the gross profit and we deduct the expenses. It looks at what percentage of each sale dollar is left over to pay tax and give money to the investors or reinvest into the business. So we're looking at the overall profitability of the business, and it uses the income statement. The ratio is net profit ratio equals net profit divided by sales times 100. Again, you need to write this down as the net profit ratio. And let's see where we get the figures from. So we need to find the net profit first of all, and this is here down at the bottom of the income statement. So the net profit is 201.60. The sales is still 984.950. This calculates out to 0.02 or 2%. So 2% of the total sales, it generates net profit. Also means that for $1 of sales, Amcor has generated 0.2 cents in net profit. If the previous year the net profit ratio was 2.2%, that means they've fallen pretty close to last year, but slightly lower. Now a business would need to look at this and say, is that amount of profit acceptable against the industry standards and against our future goals? The third profitability ratio is return on equity ratio. It compares the net profit before tax to the equity that is invested into the business. It tells the owners of what reward they will get for the risks of putting their money into the business. Again, it uses the income statement, but it also uses, in this particular case, the balance sheet, because we need to know the total equity in the business. So the calculation for the return on equity ratio is return on equity equals net profit divided by total equity times 100. And where do we get the information from? Remember, we're looking at two different statements. Our net profit comes from our income statement, and again it is 201.60. Our owner's equity or total equity in the business comes from the balance sheet, and in this case it's 4123.90. That gives us a sum of 0.048 times by 100 gives us 4.8%. That is the return that investors who put their money into the business will get from the profit of the business. Now consider this. If you were an investor and you had the opportunity of putting a large sum of money into different areas, you could put it into a bank account, a long-term investment, shares, a myriad of different areas you could invest your money. You would definitely need to look at the return on that investment for this particular company. At the moment, you'll be receiving 4.8% interest or dividend on that. Could you get a higher rate from a long-term investment with a bank? Is it too risky to invest that amount of money for a 4.8% return? That's the end of profitability ratios. I hope you understand them. Please send questions, please ask questions if you're not sure, and practice calculating each of those ratios. Thank you.